The S&P 500 is up 15% this year, on the back of 2 straight years of more than 20% gains. The financial news is buzzing, and you hear the B word everywhere: bubble. With valuation hitting levels we haven't seen since the dot-com era, everyone is asking the same questions. Are we about to see a massive crash? Is this 1999 all over again? Well, in this video we are going to cut through the noise. We'll break down why the single most quoted valuation metric is dangerously misleading in today's market. We'll pinpoint where the real speculative bubbles are hiding, and I will show you why the market as a whole might not be as fragile as you think. And most importantly, stick with me to the end, because I will reveal the specific undervalued sectors that I believe present the vast investment opportunities right now, proving you can profit even when the market looks expensive. Okay, let's tackle the elephant in the room: the price to earnings ratio, PE ratio. At over 22 times forward earnings, the S&P 500 looks historically expensive. Case closed, right? Not so fast. Comparing the market of today to the market of 2000 based on PE alone is a classic apples to orange mistake. The quality of the companies leading the index is fundamentally different as the weight. Today, the S&P 500 is dominated by high-margin, cash-generating giants. This isn't speculative, debt-fueled growth. The massive investments we are seeing in technology, particularly in AI, are being funded by free cash flow from these big companies. We see no systematic risk of bank failures or companies facing financial difficulties like we did in previous cycles. The market is fundamentally strong. The optimism around AI is also very real. Unlike the abstract internet promise of the 1999, we are already seeing signs that AI is revolutionizing entire industries. Are investors too optimistic about AI and their future profits? Probably. But there's an even bigger problem with PE. It completely ignores growth. In fact, S&P 500 earnings per share are currently growing above 10%, a historically high rate, mostly thanks to big tech outperforming. A much better, though still imperfect, metric is the PEG ratio, which is the P ratio divided by the earnings growth rate. If the market's P of 22 is matched by historical average earnings growth expectation, it looks expensive. But if that PE is supported by 10 to 13% expected annual earnings per share growth, as many analysts predict, suddenly that valuation doesn't look nearly as scary. The whole thing comes down to future earnings. PE is about the past, investing is about the future. So, what's the verdict? I believe the market is fairly overvalued, but not in a systemic 1999 style bubble. Instead, we have a tale of two markets. On one end, you absolutely have pockets of pure speculation, what I would call mini bubbles. The real froth is heavily concentrated in sectors like unprofitable quantum computing, the highly volatile crypto space, and certain plays in nuclear energy and uranium, where investors are piling in based on hope and a story, not on current fundamentals. Investors are buying these companies at surreal PE ratios or no PE at all, without caring about valuation. On the other hand, you have the big tech leaders. Yes, they trade at a premium, but that's because their earnings growth has been phenomenal and they have been performing very well. Here is the key. If we factor in the consensus growth expectation for the S&P 500, which range from 10 to 13 earnings per share growth in the year ahead, the current P ratio starts to look much more reasonable compared to historical growth-adjusted valuation. Ultimately, the future price of any stock is driven by future earnings. It is a simple mental model to use. For this to be a true dot-com level bubble, you have to genuinely believe that the S&P 500 deserves to crash like 40% and the Nasdaq at least 50%. If that seems highly improbable, then we are not in that kind of catastrophic bubble territory. Is the market going to crash in the near future? No one knows that. That's the truth. If someone is saying that online, they are just speculating. It's impossible to know the future, and the greatest minds know that. The greatest investors doesn't invest based on economic prediction. Usually they prefer to ignore the doom and gloom we see in the news, and that looks very wise. Now, it is the most important part of this video. The S&P 500 story is being distorted by a handful of mega cap stocks. If you strip them out, the S&P 493 is trading at a much more reasonable, even historically fair valuation. This reminds me of Warren Buffett during the dot-com bubble. While the world was piling into tech stocks, Buffett and Berkshire Hathaway were quietly buying things like Coca-Cola and Procter & Gamble. They were making money because they were buying quality defensive and staple companies at a massive discount simply because everyone else was obsessed with tech. There is always opportunity, we just have to look for. So, where are those opportunities today? First, defensives. Because everyone is piling into high growth, high risk assets, boring and stable companies like utilities and consumer staples are trading at a discount. No one wants to buy the unsexy stocks. That's your opportunity. Second, healthcare. Non-cyclical demand and stable earnings make this sector compelling, and uncertainty around pharma tariffs have been weighing on the healthcare sector. Smells like opportunity to me. Third, software. Established SaaS company. These companies are at a discount because investors fear that AI will weaken their competitive advantage and moats. If you believe their business models are durable, this is a massive buying opportunity. And finally, small caps. For example, Russell 2000. These have massively lagged the large caps and offer significant catch-up potential. Of course, you should always do your research first. This is some sector examples that I believe that is the biggest investment opportunity at the moment. So let's wrap it up. First, don't let the scary headline PE ratio fool you. The market today is fundamentally stronger and more profitable than in past cycles, and the real driver is future earnings growth. Second, while some areas are absolutely bubbly, the overall market is not on the verge of a dot-com style collapse. And third, and most importantly, remember the lesson of the past. When everyone piles into one hot team, they create massive buying opportunities in other high-quality stable sectors like defensives or undervalued small caps. What do you think? Is the market in a massive bubble, or is the fear overblown and simply creating a buying opportunity? Let me know your take in the comments section below. And hey, if you got value from this breakdown and want more nonsense investing analysis, and make sure to hit that subscribe button and turn on notifications so you don't miss the next video. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.